Silver has finally stopped screaming on the chart, but if you look under the hood, nothing about this market is calm. OG, John AG here, and today we're going to walk through why this so-called stabilization in silver is actually the most dangerous phase for anyone who thinks the crisis is over. Global silver prices have cooled off after an incredible period of volatility, but in China, the shelves are not refilling. Investment demand and industrial demand are draining stockpiles, and the people who actually need metal right now are paying up to get it. This isn't a price-only story. This is about backlogs, backwardation, record premiums in Shanghai, short sellers paying to escape delivery, and inventories at their lowest levels in more than a decade. That is not what a relaxed market looks like. That is what a stressed system looks like right before the next leg. This is financial warfare education. We don't chase hopium, we read structure. We're going to walk through why silver's volatility reset is actually a setup, what a backlog of orders and backwardation really mean, how Shanghai's record premiums are screaming, "I need metal now," why Chinese inventories at decade-low levels matter for everyone, not just China. Let's get into it. Segment 1, the calm, after the storm headline today. Silver calms after a turbulent period. Sounds soothing, right? But think about what just happened. Silver ripped over 60% in the first few weeks of the year, and then gave most of it back in a historic sell-off after the end of January. That kind of round trip isn't normal. That's not just another day in a liquid market. That's emotional, leveraged money getting in late and getting blown out even faster. Now, after all that chaos, prices have stabilized. The candles are smaller. The intraday swings look less violent. On the surface, it feels like the market took a deep breath. But in real markets, calm after extreme volatility often means one thing. Positions have shifted, but fundamentals have not been fixed. The players who got wrecked are out, but the structural shortage is still there. This is the part where most people go back to sleep, and this is exactly the part where you should be paying attention. Segment 2, backlogs and backwardation. The market is yelling. Let's talk about two words most retail investors never think about: backlog and backwardation. Right now in China, there is a backlog of orders for physical silver. Domestic producers and traders are struggling to fill those orders on time. When you have a backlog, you don't need a PhD in finance to know what happens next. Short-term prices get pushed higher. The market is showing this through backwardation. Normally, futures prices trade above spot. You pay more for delivery later because of storage and financing. That's called contango. Backwardation is the opposite. It's when the front-month contract trades at a premium to later months because people are willing to pay extra to get metal now, not later. This is exactly what's happening. Silver is severely backwardated because the market's overwhelming preference is for immediate delivery. Traders are saying with their money, "I don't care about a promise for 3 or 6 months out. I need bars today." You don't get that structure in a market that's truly relaxed. You get that structure in a market where supply is tight, logistics are strained, and people are worried the metal might not be there if they wait. Segment 3, Shanghai, record premiums and empty shelves. Now zoom in on Shanghai because that's where the clearest stress signal is flashing. The front-month silver contract on the Shanghai Futures Exchange is trading at a record premium. Not a small uptick, not a slightly elevated level, a record premium for timely delivery. Why? Because deliverable material has been depleted. The exchange is facing an outright inventory crisis in that front contract, according to a senior analyst at Sichuan Tianfu Bank. There simply isn't enough metal in the right place at the right time to satisfy all the people who want it right now. And it's not just futures. Short sellers on the Shanghai Gold Exchange, people who bet silver would fall, are paying deferral fees to long holders so they don't have to deliver metal. Let that sink in. If you're short and you're confident silver is abundant, delivery is just part of the game. You give the metal, you buy it back later, move on. But if you're short and you can't easily find physical silver to deliver, you start paying the other side to roll. You pay a fee just to avoid having to hand over metal you don't have. That's not theory. That's a real cost coming out of somebody's P&L just to dodge delivery. It tells you exactly how tight the physical situation is. Segment 4, 61% up, then wiped out. What that actually means. Let's rewind to the start of the year. Silver gained around 61% in just the first few weeks. Think about how crazy that is for a global monetary and industrial metal. That's not some micro-cap penny stock. That's a core commodity ripping double-digit percentages in days and weeks. Then almost as fast, a historic sell-off kicked in after the end of January and erased much of those gains. This kind of pattern tells you a few things. Speculative money, especially in China, piled in aggressively. At some point, the market ran out of marginal buyers at those levels. Leverage, margin calls, and forced selling accelerated the down move. But underneath all of that, physical demand and inventory tightness never really went away. The proof? Even after that violent reset, we still have backlogs in China, severe backwardation, record Shanghai premiums, short sellers paying deferral fees. Those are not features of an oversupplied market. What happened is simple. The speculative froth got blown off the top, but the structural stress remained. Segment 5, Silver, Gold, and the Dollar, Reserve Asset Moment. Here's a detail most mainstream write-ups will only give you one sentence on. Silver briefly surpassed gold as a reserve asset, not in total value, but in terms of the narrative and positioning during that speculative surge. There was a moment when, amid fears over the US dollar, questions about the independence of the Federal Reserve, and escalating geopolitical conflicts, silver became the hot reserve trade. Not just gold, silver. What does that tell you? It tells you that in the minds of a lot of traders and institutions, silver is no longer just the poor man's gold or a sidekick metal. In a world of currency anxiety and geopolitical risk, it's starting to be treated as a serious reserve asset in its own right, especially in China and other Eastern markets. Combine that with Chinese speculative buying, and you get exactly the kind of firestorm we just saw. Violent upside, violent downside, and a system that never truly stabilizes because the underlying problem, weak fiat, tight supply, never gets resolved. Segment 6, China's decade-low inventories. Now we come to the part that should make every long-term stacker sit up straight. China already went through a global supply squeeze in the fall. That wasn't some small blip. It was an extreme move in an already illiquid silver market. By the time this latest storm started, Chinese inventories were already exhausted. Investment demand surged. Industrial demand kept humming, and stockpiles at SHFE and SGE-affiliated warehouses dropped to levels not seen in over 10 years. Think about that. The world's manufacturing engine, one of the biggest consumers and investors in silver on the planet, is sitting on the lowest exchange-linked inventories in more than a decade. What happens if another wave of investment demand hits? What happens if industrial buyers need to top up inventories at the same time? What happens if Western investors finally wake up and try to pull physical out of ETFs and vaults? You quickly move from tight to critically tight, and in a relatively illiquid market like silver, that can mean extreme moves again. Segment 7. Why this calm is more dangerous than the volatility. Most people are scared by chaotic charts. They panic when silver is moving 5-10% in a day. But the more dangerous phase often comes after the big move, when volatility compresses. People declare, crisis over. Positioning quietly reloads. Inventories remain low. Structural issues are unsolved. That's exactly where we are now. Silver's momentum reset has cleaned out weak hands and late-stage gamblers. But the tight supply in China, the backwardation, the record premiums, and the decade-low inventories are all still there. This calm gives you the illusion that the system has healed. In reality, it has just reset the clock and set the stage for the next leg higher. As the article itself hints, this reset sets the stage for the next leg higher, not for a return to cheap, sleepy silver. Segment 8. What this means for traders versus stackers. If you're trading paper silver, respect this new regime. A calm tape can flip back to 5-10% daily swings without warning when a new wave of orders hits a backwardated, inventory-starved market. Shorting a market with record front-month premiums and tight deliverable supply is playing chicken with a freight train. Your edge here isn't guessing the exact day of the next spike. It's understanding that the distribution of outcomes is now much wider than it was when silver was just another boring metal. If you're stacking physical, this entire story is your macro backdrop. China's inventories at decade lows, backlogs and backwardation, short sellers paying deferral fees because they don't have metal, a 61% surge, a brutal flush, and yet no meaningful replenishment of stockpiles. That's not a time to over-optimize pennies on the entry. That's a time to ask, how much of my net worth sits in things that can be printed, and how much sits in things that can't? I'm not telling you to mortgage your life to stack silver. I'm saying, understand that this calm is fragile, and the physical market is already screaming that the system is stretched. Outro. Read beyond the headlines. So here's what the data is actually saying today. Global silver prices have stabilized after a violent run-up and crash. China's supply is constrained. Backlogs are pushing short-term prices higher and creating severe backwardation. Shanghai front-month contracts are at record premiums because deliverable material is depleted. Short sellers are paying deferral fees just to avoid having to deliver metal they can't easily source. Chinese inventories at SHFE and SGE-linked warehouses are at their lowest in more than 10 years. That is not a relaxed market. That is a market catching its breath while the structural problems get worse. This is financial warfare education, not advice. Do your own due diligence. Protect your capital. Manage your emotions as ruthlessly as you manage your positions. If you made it this far, tell me in the comments. Is this calm just the eye of the storm for silver? Or do you think the worst is over? And if you're one of the few who watches with your brain turned on, drop OG John AG down below so I know who you are. OG out.